Hello and welcome to the macro of it for the week beginning, the October the 16th, 2017. Much bigger week this week, and from an Australian-centric point of view, there are two countries to really be watching. There is data from Europe and the US, but I slightly want to ignore that. It's China this week, and it's also us. I want to start on China first. They have their biggest meeting in the last 5 years with the start of the People's National Congress on Wednesday. Don't expect to hear much out of it this week, but come Sunday night, at start of Monday next week, it will be a big story, and it's clear that there is some big changes going on the geopolitical side in China, and that is likely to filter through into commodities. It's likely to also filter through into just Asian trade as a whole, something just to keep your eye on and watch from afar. Also want to point out that this week they've got a lot of data themselves. They've got their CPI data coming out on Tuesday, and then the big ones that are coming out on Thursday. GDP is clearly the biggest part of it, but you do also get fixed asset investment, you do get retail sales, and you do get their IP, so industrial production. All of that is big data for us. And again, it gets back to that geopolitical idea that the commodity story over the last 6 months has been a real good boom period for us. It's really helped, particularly the government's bottom line. It's also helped equity investment as well. It's helped their net export position on an economic point of view on the other side. So any changes here just gives you that idea that I have been alluding to, that there may be a bit of a change. It's only a short-term one, but you may see a bit of a slowdown, and all of that kind of data will come out over the next week or so. Then let's look at Australia. You get both the minutes on Tuesday, and then you also get the employment numbers on Thursday. The minutes will be interesting. As I spoke about when we did the economic review, and I did this with Tony, it was around very much how neutral the statement was. They really did shed off their hawkish tone. They really shed around the idea that they weren't going to follow the global leads around national banks possibly moving interest rates higher across the board. They are very much on their own and are now looking at domestic numbers. And the best thing about the minutes is that they're going to have a bit more detail. They were clearly concerned about retail. They were clearly a little bit caught up with the fact that things just aren't materializing at the same rate, particularly in inflation, that they had forecasted. But all of that should come out in the minutes. Then Thursday, the employment data. Employment is the reason at the moment that we're actually more optimistic, which is an interesting sort of conundrum in itself because wages aren't moving, but employment is part of the reason where the consumers are back positive. And on Thursday, you should start to look to see probably about 45,000 jobs added. I've told you many times before, you need to look through that data, look at full-time employment on a yearly basis and whether or not it continues to outpace part-time and whether or not there's any impact on unemployment. I actually don't think there will be. Unemployment should probably hold at 5.6%. But again, all of this is just showing signs of strength and why the economy has been forecasted to be stronger in 2018 and why we're turning more optimistic. And that is the figure this week that I'd really concentrate on.